Hello everyone, this is Alex Suslov, Head of Capital Markets at A&D Mortgage with our AD Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. Last week was full of events and has sparked a huge sell-off on the market. FOMC's decision was to raise rates 75 basis points. And the key driver for the market was indication of holding Fed funds rate elevated for a longer period. October's non-farm payrolls gain was at 261,000 versus 193,000 expected consensus, with employment rate slowly growing to 3.7% mark. As for our internal updates, I want to remind our partners we're looking right now to enter HELOC space. Property values are up and most of US households have opportunity to extract equity from their houses. Aside from that, small balance commercial properties and mixed-use properties are in development at AD Mortgage right now. With this being said, turning it to Billy at this moment to get more insight on last week's crazy ride. Hey Billy, how's it going?
It's all good, Alex. So a week ago, the Treasuries had just completed 40 to 50 basis point rallies, and those rallies seemed to have come out of nowhere. And we were waiting on two important news items last week: Wednesday's Fed rate decision along with the accompanying statement, and Friday's Bureau of Labor Statistics report showing the job status. As you touched on, Alex, the Fed raised rates 75 basis points to 4%. And while the statement didn't get a lot of press, I'm thinking maybe it should have. I'll get back to that in a minute. Yields did move higher after the rate decision, really mostly on Thursday. Then on Friday, we learned that for the seventh straight month, non-farm payrolls were far stronger than experts had predicted. The unemployment rate did rise from 3.5 to 3.7. I think they were expecting 3.6. But every other component of the report was bearish. Non-farm payrolls, which is the key component, were expected to be up 197,000, and yet they showed an increase of 261,000. I think in any other world, treasuries would have sold off hard. But not even an hour after the report, the 5 and 10-year were both trading better than where they had closed on Thursday. The 2-year and 3-year did trade softer that day. The 2-year has now made it to 4.88, which is the highest yield any treasury has seen in more than 15 years. So I went back and did something I haven't done in years, maybe ever. I went back and I read the FOMC statement that was released on Wednesday. And there was one sentence in that statement that just jumped out at me, and I think it's very important, so I want to get it right. Read it. In determining the pace of future increases in the target range, meaning for Fed funds, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation and economic financial developments. So what that seems to me to be saying is, while they will now consider how much they have already raised rates, they're going to consider the fact that they've already raised rates basically 400 basis points. And they're going to acknowledge that there is a lag between what they do and the impact that it will have on, in this case, inflation. So it seems to me to be setting the stage for them to back away from a 75 basis point rate hike without necessarily recent data supporting that move. We have CPI coming up this week, but after seeing the reaction we just saw to the BLS report, I'm not sure that we're going to see much of a reaction to CPI. We're going to head into December with one more jobs report in front of us, but I would not at all be surprised to see the Fed go 50 basis points in December and maybe start to tail off from there and wait to see what the impact is going to be. Back to you, Alex.
Billy, I appreciate the overview. This week should be indeed eventful with voting and CPI numbers released. We'll see how that goes. Make sure to follow us on YouTube channel, like this video and subscribe to Billy's daily market newsletters to stay on top of the capital markets events. Thanks everyone, it was Alex Suslov, Head of Capital Markets at AD Mortgage. Stay tuned.